All right, good morning, everyone. Welcome back to CMU Energy Week. In case you're joining us for the first time this morning, my name is Daniel Tachik, and I'm the Executive Director of the Wilton E. Scott Institute for Energy Innovation. And along with our Director, Costas Samaras, our Associate Director, Valerie Karplus, and our amazing team at the Scott Institute, we welcome to the 8th annual CMU Energy Week. This is day 3, and we're excited to kick things off. Today, we're really going to be leaning into the last word of our institute's name, which is innovation. So we think it's super important that the research being done here and at any higher educational institution is translated out into the real world in the form of commercializable technology into a startup company that can actually have real impact on the world. So today, we're going to be hearing from both sides of that equation. One from the startup companies themselves, but also from the investors who are looking at those startup companies, seeing who has the most promise, and making investments into actually making real change and working towards a more sustainable energy future. So just before we get started this morning, I also want to say another quick thank you to our sponsors. I'm not going to go through name by name. I did that yesterday. But if you see anybody walking around today with a little thing, well, I'm not wearing my name badge, but I'm not a sponsor. If you see it saying sponsor on their name badge, say thank you. Like, it is because of them that we're able to keep this event open and free to everyone. And so we're so thankful for that. Thank you to all the sponsors. So with that, I would love to invite our mentor in residence, Reed McManigal, to the stage. He's going to give you an overview of what to expect from today and introduce our keynote speaker.
Good morning, everybody, and welcome to day 3 of Energy Week. So I work in technology commercialization. I'm in the tech transfer office. I'm so excited about this day. This is the day when we get to hear about what's going on in the investment world, in the energy space, climate tech space, and also what innovative companies are in our region and what exciting new technologies and businesses we're working on, and then the scrum of investors meeting with entrepreneurs. So that makes my heart sing. So just to give you a little background on our keynote, and then I'll tell you a little bit more about the run of the day. So Christina Chang from Lowercarbon Capital has graciously agreed to join us today. She will be doing both the keynote, she will be participating in the panel discussion, and then she's also going to be meeting one-on-one with companies. So she's a chemist by trade. She has a PhD. She's also an entrepreneur, climate tech founder, and she's invented technologies in the nanomaterial space, catalysis for mining waste remediation, thin film solar panels, solar water splitting for H2 production, and sustainable steel. So, wow. She's a partner at Lowercarbon Capital, which she's going to be telling you more about. It's a multi-billion-dollar VC fund. This is their phrase: backing kick-ass companies that fix the planet profitably. My scroller isn't working. Here we go. Yeah, previously, Christina had led federal funding for sustainable manufacturing research at ARPA-E, which is the Advanced Research Projects Agency for Energy, so sort of blue sky, change the world kind of funding out of Department of Energy. And she worked on funding of projects in steel, chemicals, cement, rare earth elements, and carbon negative building materials. So she has a really broad view from a technical perspective, a funding perspective. And then prior to that, as I said, she was an entrepreneur. She was a founder and CEO of sustainable steel startup company, Abrase Engineering. She has a PhD in physical chemistry from Harvard, MSc in sustainable energy futures at Imperial College London, MPhil philosophy master's in chemistry at University of Cambridge, and a AB in chemistry from Princeton. So please, wait, she's gonna do this and then I'm gonna introduce the panel after that. Right, yeah, so Christina, please. Please join me in welcoming Christina.
Thank you, Reed. I was going to have to pull you off stage with saying all of those degrees. It's really too many degrees. You don't need that many degrees, guys. Good morning and thank you. So, I'll kick us off with something that we all know, but to put us on the same page, our emissions have made the planet hotter than ever. And we're at 1.2 C above pre-industrial levels right now. 2 degrees C would be mostly bearable, but at 6 degrees C, that is where we get to humanitarian crisis levels of bad. We're talking mass migration, crop failure leading to starvation, basically like your no good, very bad day scenario. Fortunately, we can avert this crisis. And I get my hope from the following chart. CFCs were destroying the ozone layer that protects Earth's life from DNA damage due to radiation. And in the 20-year span from 1986 to 2006, we brought them back down essentially to zero. This is what we can do with the climate crisis as well. If all of the countries fulfill their current stated goals, we can hit 2.1 C and cap out there by 2100. That would be crisis averted and basically high fives all around for humanity. And I want to challenge the folks in the room to make climate your all-in mission. We have to move urgently, and nobody's coming to the rescue. So for the folks in the room, you need to be the hero that this planet needs. And as a scientist turned investor, I get to fund the world's most ambitious founders that are building technologies that tackle the biggest climate problems and do so incredibly quickly, as fast as possible. And if there's anything that we know about technology adoption over the course of history, it's that markets are what get us there, essentially building something that's just plain better than the incumbent. And so here at Lowercarbon, we invest in founders that are building a product that's not just good for the planet, but that's cheaper and just plain more performant than the fossil guzzling version. At Lowercarbon, we have $2 billion to spend on what we see as the 3 pillars of fixing the planet. Those 3 are here. First is slashing new emissions, making sure that we're not putting more greenhouse gases into the atmosphere, basically across every sector of the economy, from how we move and get around, to how we make things, to how we shelter ourselves and stay cool or warm. But number 2, even as we're turning off the tap, we also need negative emissions technologies. To meet these stated goals quickly enough, we have to be pulling CO2 and other greenhouse gases out of the atmosphere. And then 3, unfortunately, things are going to get worse before they get better. And so many folks are inequitably on the front lines of climate change, and we're backing companies that provide resilience, whether it's forest fire taming robots or predicting when floods are going to happen and more. So in short, all of these things taken together start sounding like a complete overhaul of the entire economy, basically an industrial revolution. So earlier this morning, I asked Midjourney what this industrial revolution is going to look like, and this is what it spat out. I think this is Pittsburgh, and we've got a lot of solar panels and a high-speed rail that may or may not be on the right track, but mostly, and what is this? But mostly this looks pretty good, and we all know these tools are taking inspiration from our real-life inputs, and I took one look at this image, and I thought, I know where you got that. Pittsburgh has done this before. In this drawing from 1857, you can see new energy sources and ways of moving things around that are based on those energy sources. And when I got to thinking about framing this talk, it feels so appropriate to me that Pittsburgh is the site of this conference and the site, potentially, of the clean energy revolution. Because if you look at industrial revolutions over time, there are 4 things that powered each revolution, and we have them here at CMU and here at Pittsburgh. And those 4 are shown here. The first is natural resources. Today it's not coal, but excess or free clean electricity. 2 is money, whether it's government funding, corporate commitments saying we're gonna spend money but by 2030, 2040, 2050 to meet these goals, and of course VC dollars. Also innovation. So we're at the heart of what some of these science and technology breakthroughs that are going to make these new ventures possible is starting to look like. And then the 4th ingredient for industrial revolutions is human capital. 150 years ago, that was population growth. And today, that is folks that are trained in areas that we're going to need to succeed in the clean tech revolution. So I have 1 slide on each of the first 3. The 4th is here in the room. With respect to natural resources, I mean, the graph says it all. Solar and wind are just cheaper than fossil versions of making power. And of course, there are needs to make them stable and baseload. But the point here is that these clean power sources are able to drive new ways of using electricity that weren't possible before. For example, using electricity instead of natural gas to do heating for manufacturing. And I said there's money on the table. Availability of capital is how these revolutions happen. And I think folks, a lot of the folks in this room can think back to 2006 to 2011, a clean tech bubble that mostly did burst, although we have a lot of good things that came out of it. But I went back and pulled the numbers. These aren't inflation corrected, but roughly they give you the picture from 2000 to now. That bubble was about $25 billion. That's much less than VCs are spending even in just 1 year today. And so, although it is true that half as much money was raised in the venture category in 2023 as 2022, and you may hear folks running around sort of saying like the sky is falling on VC, in the arc of history, what we see is VCs have dough to invest. 75 billion was raised in the VC category globally last year, and folks need to spend that money, and they want to spend that largely on climate. We'll get to how to weather this storm in the second half of the talk. But I also just want to point out the innovation that's available now and why this is different from even 10 years ago. For example, breakthroughs in biology are making new manufacturing possible. We have a company that is using directed evolution to help make chemicals using enzymes instead of oil. And they've been able to 10,000x their bugs, essentially efficiency of turning biomass into these new chemicals. And they've been able to do that really cheaply because of cheap high-performance compute. Another example is new electrochemistries. I'll also talk about this example where we're able to use the last several decades of battery research and battery scaling to now as tools as we build new manufacturing techniques. For example, making cement using electrochemistry instead of kilns. So with these 3 features, the folks in this room and the folks that you're going to hear from today are building revolutionary ventures. So in today's market, what does the path look like for those ventures? So here's a sort of canonical, I'm not sure where I'm supposed to be pointing here. Here's a canonical timeline, if you will, of the cash in your startup's bank account. And your goal is to move up without needing to get that money from anybody else. And time just moves us along, of course, on the x-axis. At the end, you're going to have an exit event, whether it's an acquisition or an IPO. And what I'm going to talk through in the second half of this talk is what we're seeing in these markets here at Lowercarbon and what founders at each stage are doing today in order to be successful. Now, at each stage, you raise roughly an amount of money for you to hit milestones over the next, call it 18 to 24 months. Those milestones show that this is working and enable you to raise that next amount of funding. Now, I'm going to talk through lessons from each of these stages from the present market, lessons from the last year, but I'll start at the back. So what's happening today at the IPO and growth stage is pretty interesting. So let's flash back to 2 years ago. Say Series C was going to be the last amount of money you needed to raise. You were going to spend it, and then let's pretend this was the IPO. You were going to raise a bunch of money on the public markets, and that was the last stage that you needed before you're cash flow positive and you don't need to raise any more money. So here you raised money 2 years ago because you're going to IPO in 2 years. Well, of course, what happened was an economic recession, making public markets more risk averse and less risk prone. So now that IPO isn't going to be possible because folks want less risky stocks, essentially. And that means that folks that were planning to be able to get a cash infusion in 2 years are now having to wait, say, 3. That was not on schedule. So what I'll talk through is how at each stage, this is having ripple effects, across. Well, essentially, here are the 2 ripple effects that this backup effect is happening. Investors that wanted to see an exit in 2 years are now holding off until public markets warm up again. And of course, already in 2024, we have seen higher performance in markets, so we're hoping that that's this year. But that means that that folks are having to be more creative about, one, how they stretch their runway in order to stay alive before they can raise that round. And 2, because half as much money was raised in the venture class of assets compared to previous years, they may need to hit twice as many milestones compared to what they were preparing to with that money. Or they're going to be able to raise half as much money on average compared to what they had thought for their next round. And so I'll walk through 3 examples today of startups at 3 different stages that are being creative and succeeding in this market, even given this reshuffling. And I'll start at Series D and move upward in the chain. So the first company that I'll talk about is Solugen. This is the company, like I said, that's using bugs to make chemicals, and that's ending up being just cheaper than doing it in the fossil version. So this is a busy slide, but it gives you the gist. So making chemicals, as you know, in an oil-based way involves a lot of separations. And what these folks appreciated was that if you can use enzymes for most of the transformations, enzymes, of course, are very efficient in doing highly specific transformations. And they went from PVC pipe sort of early prototype in their basement, not recommended, like not super safe, but it worked, to full-scale, multi-kiloton bioforge, 3 stories tall, in under 6 years. They did this by focusing on not only a transformative technology that was related to their background for both of them, but also making sure that they could get revenue quickly. In the early days, they were making hydrogen peroxide as their first chemical, and they were putting it on baby wipes during the pandemic because moms wanted sort of clean. They would pay a little bit more, disinfectant during the pandemic for their babies. And so these folks were super nimble and also appreciated that even though they were outsourcing to sort of a baby wipe company for some of that manufacturing, they could make more money by owning more of the value chain. So they pivoted to other chemicals that also were where they could also make more money. They're making hydrogen peroxide and glucaric acid today, and they're selling those chemicals to oil and gas companies who don't give a damn about climate. It's just cheaper to buy it from Solugen than to buy it from themselves. They have 9-figure run rates right now, and Bioforge 2 is already sold out. So this is an example of a team that moved incredibly quickly and nimbly in order to make things that folks just want. So they got customers as early as humanly possible. What's working for them at Series D is being able to leverage government money, as well as showing how they have a pipeline of other chemicals that they're going to be able to make. And so they spend some of that revenue on showing how their market is going to get even bigger over time. So these are important lessons for folks that are, trying to IPO in the next couple of years, showing how the public markets will be favorable for them. My second example, is a company that did really well at Series B. And at Series B, so this is Charm Industrial. They are doing carbon dioxide removal from the atmosphere via biomass. And they're taking that waste biomass, gasifying it. So you have 3 fractions, gas, liquid, solid. They're using the gas part to run the whole operation. The oil part gets pumped back underground. And the solid part goes back on the fields because it has NPK, basically fertilizer in it. And Charm sort of faced a dilemma pre-Series B. They thought they had the right amount of money to build, so I'll go to the slide. They thought they had the right amount of money to build the perfect gasifier that would be incredibly energy efficient and make as much of the bio oil, the liquid fraction, as possible. However, given these changing markets, they pivoted because they realized that they needed to show that they could make money as fast as possible, especially in a market like carbon dioxide removal, where we're still seeing exactly how much folks are going to pay for 1 ton of CO2 removed from the atmosphere. I mentioned this bucket 2 earlier. Corporates are making these 2030 goals, but they can't change their operations fast enough to a clean version. And so they're needing to make up for that with carbon offsets to meet those 2030 goals. And Peter, the CEO, realized that they could tap into some of these carbon markets ASAP and get creative about how they could get revenue if they could do this gasification process as quickly as possible. And so they pivoted from making the world's best gasifier to buying off-the-shelf gasifiers, and they're going to improve the technology and make tweaks over time. That allowed them to deliver many tons of CO2 removed ASAP and land a $60 million contract with JP Morgan, among others. So they found a buyer that was interested in meeting their goals soon, working with a credible startup. They involved a third party that is the monitoring, reporting, and verification sort of like CYA third arm, because of course the chief sustainability officer at JP Morgan doesn't want to get fired if this stuff ever comes back up or something like that. And so they created the conditions to get money even before they had delivered those tons so that they could buy those gasifiers. So another example of how you basically need 10 million plus in revenue as sort of signed as you possibly can pre-Series B in order to raise that Series B. My final example is a Series A company. This is Sublime Systems, a company that, much like the startups that you're going to hear from today, spun out of a technology, based institution. They spun out of MIT in 2019 with a way to make cement using electrochemistry at ambient temperature instead of at very high temperatures using fossil-fired kilns. And their research paper was published in PNAS in 2019, and the company spun out soon after. And we helped fund them in the Series Seed round. Here's the busy slide with Leah Ellis, the postdoc who invented the technology, and Yetming Chang, the professor who co-invented the technology, a serial founder. And they realized that, even during the pandemic and these shifting markets, that they weren't going to be able to lock in a a construction customer with like tiny samples, and probably weren't going to be able to get revenue before Series A, that 18-month runway. But they wanted to be on the way to getting revenue as fast as possible. So on that seed money, which was, like a couple $1 million, they built a pilot that made 1 ton per month of cement. So they could send volumes of samples to multiple potential customers that were actually on the order of magnitude of scale that folks were willing and able and interested to test. They also got immediately on the path of doing their own ASTM testing in order to make sure that, both they were comfortable and their customers were comfortable with the performance of the cement. So this was an example of a company that realized that, that they needed to get to scale ASAP. And so we funded them, at the Series A, even before revenue, which is sort of where Series A companies are right now, because we could see that they were on that path. To conclude this section, I'll talk a little bit about what we're looking for at Lowercarbon in terms of our investments. So we tend to invest at the pre-seed and seed stage. We love to be the first check in. So really excited to work with universities and professors on their journey and give feedback as folks are ideating what venture concepts they want to spin out, or even what research projects they want to get funded in this space. Happy to tell you like what we're seeing and what we're not seeing that we would love to see. I sort of created like 6 categories of things that we're roughly looking for. We do a back of the envelope calculation. At scale, would this save billions of lives? Would the climate impact be, 200 plus megatons of CO2e, or, 1% or so of global greenhouse gas emissions? 2, would the economics be attractive around the world? Because like I said, we achieve scale when everybody is able to buy this thing. And on the technology side, are you actually solving a problem that is a splitting headache for folks? Or are you just solving a nice to have that they won't actually prioritize, bring to their boss, et cetera? And is this solution better than what else is out there? How differentiated is this concept? And how is your IP moat changing over time? Are you continuing to innovate even as fast followers may want to catch up? On the people front, we ask ourselves, is this venture the natural conclusion of what this founder has been working on and doing and experiencing for the past few years? Why is this the right person to solve this problem? Founder problem fit is one of the most important things because it sort of has to be your passion area. You're going to run through walls for this company, and that passion is going to keep you going when the chips are down. And finally, we look for a whole team that is getting stuff done with urgency. You don't have to come with the best first idea, but are you pivoting quickly, like the examples that I mentioned? And are you pivoting to better and better ideas? To conclude, I want to give some pointers for ways forward for the folks in the audience. I wrote a sort of tell-all like blog post back in November on my journey through climate. And if you go to our website, you can read about it, or you can find it on our website. It takes you through what I see as some of the biggest opportunities, including at the very bottom, a link to a Notion document where I've listed all of my favorite things to read to get you started in finding what is your problem in climate. And each of them has like a pop out where I sort of describe exactly what my take on that reading material is and why I included it. It includes podcasts and even ways to get involved, some of which I also cover here. First thing is on our website, planet healing isn't a spectator sport. So if you want a job working for a climate tech company, it's very easy to search like remote, which city, is it IT, is it engineering, is it policy, in order to see across the portfolio of 100 companies that we have where you might find your role. And we're also hiring here at Lowercarbon. We have offices across LA, San Francisco, and I'm in Boston, so I plugged this one. I'm looking for a protege who has like great organizational skills, a technical training background, and is just really interested in helping build these companies with me. So excited to find someone who wants to grow as a leader in investing. So please come talk to me. And I'm also here all week. I'm at the Sports Center tomorrow speaking on unpacking what we're really looking for and what that founder's journey looks like, and a little bit about my career as well. So please join us for pizza tomorrow at 12:30. Ultimately, I am so inspired by the folks in this room, the folks that I've already met on campus, excited to spend all day here today and tomorrow as well, excited to hear what folks are working on. And thank you so much. Let's roll up our sleeves together. Thank you.
Thank you, Christina. I was going to plug your talk tomorrow, so I'm glad you did it already. So we have about 10 or so minutes for questions. As per Energy Week tradition, we would love for the first question to come from a student. If any of the students in the room have a question.
While we're waiting, don't hesitate to reach out. My email's here.
No students responded. Is it safe to say there is too much greenwashing with the green industrial revolution?
Say more about your question, please.
Is there too much greenwashing, too much propaganda toward the renewable energies, in particular, not necessarily in this part of the world, but yes, in this part of the world now, more talk, more publicity for it than it deserves in the industrial revolution, the green industrial revolution picture, the green revolution?
Yes, that's a great question. And I think we all heard it. The point is, like, are folks really doing anything? Are these solutions going to work? Or is there a lot of talk but no action? There are a few pieces to that. I'll say that it is really incorporated on incumbents to make good on those goals. For example, in carbon markets, what we're seeing right now is folks saying, well, yeah, we want to make a difference, but we don't even know how much CO2 we emit, especially in the entire supply chain. So yes, things are going slower than they should, because the first step is even measuring what the problem is and how big it is. So we are pushing, frankly, for folks to be able to move quickly at even 90 or 95% certainty of exactly what the error bars on exactly how much CO2 you're emitting. Because I will say that there is a lot of talk without moving forward as quickly as we could. That said, I would go back to a prior point, which is if it's just cheaper, especially if it's just a lot cheaper, if it's a lot more performant, it's a process that you can more finely control. That's something that they really want in the chemicals industry. Folks will switch. It doesn't matter if it's green or not. And so that is the style of thing that we focus on, is stuff that just makes money. Thank you.
How would you approach lower carbon capital for a project? Dear sirs, we have a project. Do we have to, what do you require for information? Just how do you approach a company like Lower Carbon?
Yeah, we're pretty casual, so email me. I mean, like, that's, and also, like, let's talk after this talk. I'm here all day today and tomorrow. We also have a forum on our website, which just sort of has, like, link to your stuff and, like, tell us more about it, a way to get involved. But the point is, because, and I have an academic background, and I appreciate that when you're building at the very early stages, you may not know exactly where you're going or how to apply this cool science that you have in the lab. Do I turn it into a product? Do I turn it into a process? Do I work on something else entirely? So trying to lower the barrier as much as possible. Just talk to me.
Okay, so my question is, if you would be able to share a little bit about a technology or an example that you really wanted to fund but couldn't because it didn't meet your financial viability criteria?
I have a great example that was a university spin out, actually, where we gave them feedback on we couldn't fund it. They followed the feedback and then we funded it. So it's sort of a good story. We were interested in a spin out from Harvard called Boston Meets. They were 2 postdocs and a PhD student in a lab that was working on basically creating muscle fibers. They had NIH funding, and the idea was to do this work for prosthetics. But all 3 of them really wanted to work in climate, and in fact, one of them was like already vegetarian, and they're like, well, hey, we're able to electrospin these muscle fibers, and they have texture. What's wrong with, not what's wrong, Impossible, burgers are great, but they're mushy, like you don't have texture. You can't really make a whole cut with them, or like a chicken breast like item. So that's what's missing is texture. We can do that with our technology. We went with the Boston Meets team just as they were interested in spinning out, and we said, we really like the team. We think the technology is super promising, and importantly, again, I think you're solving the right problem. It needs to just be tastier, cheaper, healthier, and actually have the right texture. But here are pieces of feedback and why we can't invest now. 1, what's your go-to-market strategy? You're going to be competing with Beyond Meat and Impossible and Boca Burgers. They're kind of at the bottom still. It costs money to be a consumer, packaged good and get on like prime shelf space. Is that what you're going to do? And how are you going to compete? What's your brand? Or are you going to work with chefs in restaurants? What's your in there? Like, what's your plan for this? And they didn't quite have one yet. And that is really important for the financial viability, especially in a market with incumbents and in a market with, meat is the incumbent, and then there are already sort of greener versions, right? So you have to be that much better. We also said, hey, love that it's textured, but electrospinning is never, we don't think electrospinning is going to scale because your costs are 200, 300x from where they need to be. How are you going to pivot the technology to get that cost down? And then the third piece of feedback we gave them is unfortunately we have to pass right now because you sort of had to sign a waiver to, we tried the stuff in the lab, and that was probably don't eat your lab experiments, but it was okay, but it wasn't, it wasn't great, right? They were spinning fibers out of pea protein and soy protein and that type of stuff. So it was pretty bland. How are you going to make this taste good? But we kept in touch with the team, and they did all of those 3 things. Their name was Boston Meets, which was kind of a little bit gross, but they changed to Tender, and they got a branding agency, and then they had a beautiful website, and they started changing from electrospinning to wet spinning, essentially how textiles are made. So it's way more scalable. They started working with restaurants. They're already in, by the time we funded them, they were already basically piloting in multiple restaurants and selling out 2 to 1 Impossible at those restaurants. They made it taste good via a variety of methods, but they also actually decreased the number of ingredients in there, making it cheaper. Also, the spinning made it so much cheaper. So ultimately, they knocked down all of those 3 things. They'd initially asked for $2 million, and we funded them with a $12 million round at the next stage. So this is the type of thing that I really love to do, is work with academics and help frame what we need to see to get excited. Sometimes we're that, early check, and sometimes we're, right there at the next stage. So this is not idle feedback. We really want to bring your ideas into the world.
So we have time for one final question, and it goes to Craig here.
Thank you. Christina, it feels like the world is a bit more scary, geopolitically, domestically, politically. Yes. What resources do you and your partners use to try to account for how that should affect the way you think about going forward, especially in the near term?
Craig, that's a super good question. Nobody had war in Ukraine on their bingo card, right? Never mind some of the other things that are going on in the world right now. But these companies that we're funding, just create resilience. Like whether it's, I mean, we get funding from folks on all sides of the political spectrum, because whether you're just a greedy capitalist or you want more resilience, like in your home country, or you want supply chains that you can actually trust and control, our companies are solving those things, and that is what we invest in. We invested in most of these companies before the Chips and Science Act, the IRA, and the bipartisan infrastructure law came about in 2021. Those supercharge everything that we do, and we hope that they're here to stay, but they're not a necessary condition of these companies being successful. So it is going back to that fundamental piece of investing in things that just, you know, create resilience, like lithium companies that you know, create lithium domestically so we don't have to rely on China, this type of stuff that folks are just really excited to have security of supply.
All right, Christina, this has been a truly inspirational keynote to really set things up for the day. So thank you. Please join me in giving Christina a round of applause.
Thank you.